Hello, this is the synopsis for Chapter 8, which is on life insurance. So let's move forward to the first slide here that I want to talk about. All right, so what is the purpose of life insurance? Well, it's to replace lost income for your family if you should die prematurely. Simple as that. So it can replace your lost income, help to pay for education for your kids, mortgage, etc. Just to make sure that your spouse and your significant other and your kids are cared for if you should die prematurely. So basically what you're doing with life insurance is, or in any insurance, is you're transferring the risk. So if you buy life insurance, auto insurance, homeowners, renters, you're simply transferring that risk to the insurance company so that if you do have a loss, you will be brought back to your original position, you'll be made whole again. So um, so you might ask yourself, do you need life insurance? Well, yes, if you have dependents who count on you. So if you have a significant other or a spouse, if you have children, you need life insurance. But if you don't have anyone who depends on you for support, then you really don't need life insurance. The only reason to get life insurance when you're young and don't don't have any dependents is if you feel like you would be in poor health later on in life, so you should get it now so you can lock in low rates. So what are the types of life insurance? Well, first of all, let's talk about how much do you really need. So you can use the spreadsheet, the worksheet rather, that's in the chapter, and that's basically just figuring out how much income would be lost if you die and how much income might be gained, because you would get Social Security if you're eligible for Social Security. If you've worked enough quarters to be eligible for Social Security, your family would get a death benefit. So you figure out how much you need, basically how much is lost and how much is coming in, how much the bills are, and you can figure out exactly how much you need per year. But then another way to do it is simply think about finance. Let's say that you had, let's say that if you died, your family would need $50,000 a year for the next 20 years. Because you would want to, if you had small children, you would want to provide that support until your kids maybe graduated from college. So let's just say 20 years. So let's say my family would need 50,000 a year if I died for the next 20 years. Well, all you have to do is the present value of an annuity. So you would put 50,000 in as the payment. You would put 0 as the future value. You would put 20 as N, and let's just say 4%. Because if you had the money, you would just put it in a CD. You wouldn't bank on getting 8 or 9%. So let's just say you could get 4% on the money. What's the present value of that? So let's just say, for example, that present value number is $400,000. Then that's how much life insurance you need. So you can do it in an exact way like that, and it'll tell you how much your family would need at that point. So if it comes out to say 400,000, you get a 400,000 term life insurance policy. You put the money in a safe investment in CDs, certificates of deposits, where you're guaranteed 3 or 4%. And then you have the money. You have the $50,000 to extract every year, or you can do it per month. So that's the needs analysis, where you're going to be more exact. An easier way, which pretty much comes out to be the same, is just a multiple of earnings approach. And the rule of thumb is 5 to 10 times earnings. So if my family needed, if I was, let's say my take home pay is $50,000 a year, multiply that by 10, I need term life insurance I need life insurance of 500,000. It's that simple. And so I found in the past, when I've done the needs analysis versus the multiples analysis, if you do 10 times earnings, pretty much comes out the same. So you don't have to go through all that hassle. All right, so just to recap, you can do a net present value to see what your family would need, or you can just do a multiple of earnings. You can multiply at the low end 5 times all the way up to 10 times earnings. Okay, so this is that worksheet. You can look at that on your own. All right, so what kind of policies are there? Well, there's actually four. So the first type of life insurance policy you can get is a term life insurance policy. That is what's recommended pretty much by every financial planner. I'm just going to give you the main takeaways of life insurance here. So if you buy term life insurance, it's not permanent insurance. It's life insurance for a specific term. So let's say you're 30 years old and you want to be covered. You have a family now and you want life insurance. So you might buy a 500,000 term life insurance policy. And it would be level term. I would recommend level term, which means you're going to pay the same premium for the next 20 years. And then after 20 years, the insurance is done. So that would be really cheap. A term life insurance policy for a 30-year-old probably would, for $500,000, would probably only be between $20 and $30 a month. And so you would have that insurance for 20 years, then it's gone. Now, when you're 50, when it expires, term insurance would be much more expensive. As you get older, it's not really worth it. So the idea of term insurance is you only have insurance when you need it. 20 years hence, when you're 50, your kids should be out of the house. Hopefully your mortgage is paid. You should be in a financial position where you don't need insurance. You could buy 30-year term and have it go till you're 60. Even if you got a policy when you were 40 and had it go till you were 60, it would be relatively inexpensive. For just to give you an example, when I was 42, I bought a $700,000 term life insurance policy. And actually, I'm sorry, when I was 44, I bought a 700,000 term life insurance policy. It was only $50 a month, actually $49 a month. So that just gives you an idea of how cheap term insurance is. Now, when you get into your 60s, it's not really worth it. So the idea is you have this term insurance, and then once you're in your 60s, you shouldn't need it anymore. Okay, so that's term insurance. It's it's really cheap, and it's just specifically life insurance. Okay, whole life insurance is permanent insurance. That is much more expensive, hundreds of dollars a month for a whole life policy. So with whole life insurance, you might pay the rest of your life on it, or you might pay for a specific time up until you're like 65 or 70 or 75. It just depends on the policy. So this is permanent insurance. So let's say you wanted to buy, you're 30 years old, you wanted to buy $100,000 whole life policy. That's going to cost you probably a little bit over $100 a month. And then uh, you would have you're going to have that for the rest of your life. Also, whole life insurance policies build up a cash value. So over time, there's a cash value to the policy. So if you wanted to surrender the policy, meaning cancel it, you would get the cash value. You don't get the cash value when you die. You just get the limits of the policy. But if you wanted to cash out the policy, you do get that cash value. You can also access the cash value to get a loan. We talked about loans in the last chapter, consumer loans, and I mentioned briefly you can get a loan from your life insurance company. Well, that's if you have a whole life, you can actually get a loan off of the cash value. If you should die, if you have an outstanding loan, they just deduct the loan from the payout. Okay, so that's whole life. Now, what happened several decades ago with the insurance industry is that nobody was buying these whole life policies because you come out ahead if you just buy term insurance and invest the difference. And what I mean by that is if I could get a term life policy for $50 a month, but a whole life policy of a lesser amount would be $150 a month, then why don't I just buy the term insurance for 50 and take that $100 extra that I have and invest it in the stock market? And so that's what people tend to do, and they come out ahead. So they've tried to make whole life insurance a little more um, palatable, a little more appealing by tweaking it a little bit. And that's where we come up with universal life. Universal life is whole life insurance plus a savings component. So you pay a little bit, you're going to pay more than if you had term policy, but you're going to build savings. So you have, so basically what happens is you have this, you have the life insurance component. So this universal life, you'd have, let's say it's $100,000 in insurance, but you're also paying a little bit more, and they're putting it in a savings account for you. Basically, they're investing the money for you, the company is, and they usually guarantee you a minimum interest rate on the minimum rate of return on the savings component. So when interest rates were really high, some of these policies had a 5% minimum interest, which was a pretty good deal. Now they might advertise that they think they can get you 7%, but that's not guaranteed. But they usually have a minimum. So probably today, I would imagine if you bought a universal life policy, the minimum rate savings rate is probably around 3%. So if you want to have the life insurance plus a little side account that they're building for you with a savings component, that's universal life. The fourth one is called variable life. Variable life is whole life insurance plus an investment component. In that situation, the life insurance company has some mutual funds that you can pick from. And so you have this investment component. So you're paying for the insurance, then you're paying a little bit more, and you're able to invest the money in mutual funds that the company has, so you can build up some investment. You have an investment account with them. So you've got four types: term insurance only, whole life, which is permanent insurance, plus all these policies have cash value too, so with the exception of term. Universal life is whole life plus savings, and then variable life is a whole life policy plus an investment component. All right, so what should you do? Well, what most financial planners recommend, me included, is buy the term life. Unless you really, really want to have permanent insurance, I wouldn't recommend a whole life policy, because you're better off um, uh, buying term insurance and then just investing the difference in the premiums on your own. However, if you do have the opportunity to buy a whole life policy, a group whole life policy through your place of employment, the rates are really cheap. So what I recommend is buy term insurance, and then if your employer offers whole, insurance, then I would definitely take advantage of that, because with through your employer, it's such a big pool of people that the rates are typically pretty low, so that you can get really good rates. And it's not usually a lot of insurance. For example, it might be a $50,000 policy, $50,000 whole life policy. For example, at working for the state, I have a $50,000 whole life policy. It's kind of a hybrid. I think it goes away when I turn 80, but it's coverage till I'm 80, and it's like $12 a month. So that just gives you an idea of the employers, because it's such a large pool of people, you can get a much lower rate. So that's the only time I would really recommend buying whole life. All right. So that's pretty much it for this chapter. I'm going to go through a few more things here on the slides, and but you can read the slides on your own. But that's the main rundown of the types of insurance. Okay, now that I didn't mention this, you can buy decreasing term insurance. The premiums would be a little lower, and that just means that the benefit decreases each year until it gets to zero. So let's say you had $100,000 policy for 10 years, or let's say it's a $200 policy, $200,000 policy for 20 years. It would decrease every year by a certain percentage until it got to zero by year 20. That's what decreasing term is. Um, Term insurance, sometimes you can convert them to whole life if you want. You can also renew the policy if you want when it expires. but it's going to be a lot more when you renew it. But those are some features that they have. Make sure you look at this. This just gives you an idea of how much insurance costs depending on your age. This is term. And then here they're talking about the whole life. This is whole life. So you can see the difference in the premiums is dramatic. Okay, okay, and then we already talked about the universal life. There's universal life premiums. There's variable. I don't know why they didn't have it in that one slide where they had all the policies, but all the types, but there's the variable. And then then there's group life. I don't recommend credit insurance or mortgage life insurance. Talked about that in the last chapter with credit. A mortgage life insurance, if once you buy a house, you're going to start getting inundated with ads for mortgage insurance. That means if you die, the mortgage is paid off. But that's basically decreasing term insurance when you think about it, because as you pay your mortgage off, the insurance benefit decreases. So what's the point of that? You would be better off just getting a level term policy. It's a lot cheaper, and buying this mortgage insurance tends to be more expensive anyway than if you just bought a regular term policy. So what I would do is if I bought a house for $200,000, I would probably buy a $200,000 term policy to offset that if I want, or 150,000, what have you. So, and then the credit insurance, as we talked about in the last chapter, is too expensive and it's kind of a ripoff. All right, so you can compare costs with life insurance, and you can also get with an agent. There's insurance agents who work for specific companies, but then there's these insurance brokers who don't work for a specific company, and they'll go out there and find you the best deal. And the insurance companies pay them, so you don't have to pay them anything to do this. You can also buy life insurance directly. If you have USAA, for example, if you have a family member who's been in the military, they have really good deals on life insurance typically. But you can shop around, and it's easy now with technology to get online and just find some reputable companies and buy life insurance on your own directly if you want to. All right, so the last thing I wanted to talk about was beneficiary. And viatical settlements. Okay, so let's talk about this. When you buy life insurance, obviously you're naming a beneficiary. So you have two types of beneficiaries, primary and contingent. The primary beneficiary is the person who's going to get person or people who are going to get the money if you die. If one or more of your primary beneficiary dies, then before you, then um, you would want to name a contingent beneficiary. So as typically what happens is let's say you have a spouse or a significant other, you name your spouse as your primary beneficiary, 100%, and then you name your child or children as contingent beneficiaries. So if you had two kids, you would name your spouse as primary, and then the contingent, if your spouse predeceases you, would be your two children split 50-50. If they're underage, you can say that it's to be held in trust, and then it'll just be put in a trust account and while they're minors. So that's the situation with the beneficiaries. And if you forget to pay a payment and make a payment over 30 days and the policy gets canceled, you can actually reinstate the policy by making all the back payments. Let's see. I would just go to the book and read on your own, just read about all these features on this page and here. But I do want to talk about viatical settlements. A viatical settlement or a living benefit is viatical settlement is if you have a terminal disease. If you're terminally ill, you can basically get the proceeds early. It's not dollar for dollar, but it might be 50 or 60 cents on the dollar. But let's say you had $100,000 policy and you're terminally ill, you can do this viatical settlement where you get the money early and they'll give you, say, $60,000 to help for your care. Living benefits are if you want to, it's negotiated in the contract where you can get the benefit early if need be. Suicide clause, a lot of companies have a suicide clause for the first year. So if you have a policy, it's usually 1 year or 2 years, depending on the contract. If someone commits suicide within a year of buying life insurance, that won't be covered, but after that, it would be covered. So just go, like I said, just read in the book about these features. Okay, and then that's it. So main takeaways with life insurance, make sure you know the different types of life insurance. Make sure you know what a primary and contingent beneficiary is, and make sure you know about biatical settlements. And that's it. As always, reach out to me if you have any questions. Thank you for listening.